Welcome to the Remarkable Retail Podcast, Season 8, Episode 8, presented by Celonis. I'm Michael LeBlanc.
And I'm Steve Dennis.
Our very special guest coming to us all the way from Germany, soon appearing live on the stage in Paris in April at the World Retail Congress, is Andrea Dorigo, Head of Global Retail, Adidas.
Our astute listeners will notice how croaky my voice is during the interview, and hopefully they can look past that to all the great content. Yeah, Adidas or Adidas is a very interesting brand, and I love how we get into some of the trade-offs, as we've talked about on the podcast, between DTC and wholesale and all those kinds of good things. But he brings a global perspective to a really interesting topic. And
a tremendous depth of retail experience. So it's a fantastic interview. As you said, your voice is a little croaky, but still you're doing well. You know, for having a cold, you sound pretty good, actually.
Better living through chemistry.
For the guy that has to edit it, it's not too bad. And don't, speaking of World Retail Congress, don't sleep on our discount. Still time to book a flight to Paris and enjoy the amazing roster of speakers at the World Retail Congress and enjoy a croissant and coffee along the Seine with Steve, you, served by a waiter who on the whole would rather you not be there. But you're looking forward to going to Paris, right? You will be there.
Absolutely.
Stage side.
Absolutely. I have not been to Paris in several years, and I'm looking forward to both the city and very much to the conference as well.
All right, fantastic. Well, let's jump right into the news. I mean, we got to start where we got to start, which is Macy's. I mean, it's kind of nestled in earnings. We had a lot of earnings, but there's a lot of news about Macy's. I mean, what a welcome for the new CEO. And boy, you got both news coming out of their performance, and then just as recently as today, we're recording this on Monday, news around an increase or a bump up in the offer for the business. A lot going on in the Macy's world.
Yeah, even though it's still pretty early, I've already talked to a couple reporters about the news coming out of Macy's. So who knows what the rest of the week will bring. But first thing was they did report their quarterly earnings, and we're about to get, as you mentioned, several more earnings reports from retailers this coming week. But it was another rough quarter. Not too surprising. We've been seeing some of the overall department store numbers this past quarter being quite weak. So not too surprisingly, Macy's had a weak quarter. They were down 5.4% on a comp basis. They also had their digital sales go down, which is kind of interesting. We're really seeing this mix of companies like Walmart that are reporting great increases, and then a bunch of other retailers that are having a hard time growing that. I'm not sure I totally understand that.
I think we should probably chalk it up to bifurcation, really. I mean,
it could be.
The winners keep on winning and the losers keep on, not doing so well, I think.
But anyway, we'll move ahead to the big news in a second. But just really quickly, their profits were pretty mixed. They made some progress on gross margin. As we talked about a few weeks ago, we're seeing these charge-offs go up in the credit card world. So their credit income was down, not too surprising. And then given that Tony Spring is taking over, it's not too surprising that they would take some charges. So they had about $1 billion in impairment charges, which we'll get to some of the reasons for that in a second. But, one of the things, and we've teased this a couple times, this is probably just a good time to go a tiny bit deeper. One of the things that's very peculiar about department stores, particularly in the U.S., is even though their performance has been demonstrably terrible pretty much across the board for a long, long time, many of them still make okay money, or at least generate decent cash flow. And there's a couple reasons for this. One is that most department stores pay very little rent. So classically, as some people will know, but if you don't know, you're about to learn, many of these mall deals were put together with department stores as anchors. And essentially, they often get some developer credits to help build those stores. And then they get a very sweet deal on rent, either no rent or maybe a small percentage rent. So when you're comparing the operating model of a department store against a specialty store, they often have about a 10-point advantage on operating expenses because of the low rent cost. And then you also just have generally that they're not putting a lot of money back into their stores. They're not opening stores for the most part.
And that's an era where anchor meant they were going to bring in people, not bring down sales for the whole place.
Well, yeah. I mean, the reason why developers would do that, and you still see some of these deals going on with retailers like Italy and RH that actually draw and add to a mall. But yeah, back in the 70s, 80s, 90s, the heyday of malls, you wanted to get these anchors to bake the development, well, get the development off the ground in some cases, but particularly to be a draw, to be able to sign up all these other tenants that wanted to be close to where you were because you were a big draw. But yes, now the notion of an anchor has definitely flipped. So anyway, so as we look at department stores, we'll often see weak sales, not much progress on the reported net income, but actually pretty good cash flow. Well, the other two pieces of big news from the past week was that as part of the earnings announcement, and I'll give Macy's a little bit of grace because they kind of shoehorned their new strategy announcement into the quarterly earnings announcement, which may mean it doesn't have quite as much detail as we might like to hear. So perhaps that will be forthcoming. Perhaps we'll hear Tony talk about that more when he's on stage at Shop Talk. But they announced what they called a bold new chapter. And the highlights of that, just quickly, were that they're going to close 150 stores over the next 3 years, so 50 more or less, each of the next 3 years, which will get them to about 350 stores. They are going to invest behind strengthening Macy's, the Macy's nameplate, because folks probably know Macy's also includes Bloomingdale's and Bluemercury. They're going to shift some of their emphasis to more luxury, both within the Macy's brand, as well as by opening additional Bloomies, which is a small version of a Bloomingdale's, Bloomie's outlets or Bloomingdale's outlets and Bluemercury stores. And they're going to simplify and modernize. Now, two comments. One is there are a lot of things that are in this bold new chapter which sound a lot like the Polaris strategy that Macy's unveiled 4 years ago. A lot of stuff that's pretty generic, like strengthen assortments, accelerate digital, improve your cost structure. Those all are good things, but it's very hard to look at those things and say that that is going to reverse their market share decline. So hopefully we'll see some actual customer data or more detail about how this is going to help them acquire and grow and retain more customers. At the surface level they provided so far, it basically looks like they're going to close a bunch of stores to focus more intently on the ones they have, which I would say is a good direction. But as we've talked about many times, closing stores doesn't make you more relevant. It just allows you to focus your resources more. So a lot to come here. Well, anyway, and then the last piece of news, as you mentioned, happened over the weekend, and it's just kind of hitting the market today, is that Arc House and Brigade Management, which had launched a takeover bid or indicated their interest in taking over Macy's a couple months ago, that bid was rejected a couple of weeks ago. Well, they have upped the offer, increased the price, I think, by about 21%, something
like about $1 billion, right? Something like that?
Yes.
Yeah.
So Wall Street actually kind of yawned when there was the announcement of this new strategy and the earnings. The stock went down for several days, but now here we are on Monday. It's back up because of this new offer. So we'll see what happens. I think you can absolutely make an argument that, this is a pretty significant increase in the offer, given Macy's lackluster results and given that this new strategy doesn't look to be super exciting. I think that puts more pressure on the board to consider the offer more seriously. But the timing is pretty, I think I said this a week or two ago, the timing is really awkward because when you got a brand new CEO and a new strategy, you could see the board saying, even though they have a fiduciary responsibility to consider this seriously, you could still say, well, we're just getting started on this thing and there are a bunch of outsiders coming in. Right. So I don't understand enough about all the governance issues here to know how this will play out. But I think, shots fired. Things are going to be interesting here for a while with Macy's.
One quick question for you as I look at the bold new chapter, as you said, it's got strengthen the nameplate, accelerate luxury growth, and then simplify and modernize. What do you think about their ploy to get more? Obviously, they're seeing more sales opportunity in the luxury segment. Do you think that's a genuine opportunity for a brand like Macy's? I mean, it's not like there's not a whole bunch of other folks already serving that market. Do you think there's some bandwidth for them to grow in the luxury space?
Well, it's kind of a mixed thing. I certainly, in terms of what I always say about you need to get out of the unremarkable middle to push to more differentiated service and branding and those kinds of things. That is, I would say, in general, the right direction. Tony Spring, having run Bloomingdale's for a long period of time, and Bloomingdale's has been, small-ish but relatively successful. There's credibility there, so it's not too surprising that he's playing to his strengths. It's a little bit like, why do you rob banks? That's where the money is. I mean, there's more money and there's a lot of favorable demographics generally to go higher end. So that makes a certain amount of sense. My question, and it really gets back to the same questions about the Macy's nameplate, which is, okay, what exactly are you going to do to acquire and grow and retain customers? Maybe get customers to shift away from Nordstrom or some other specialty stores. I mean, to your point, there is plenty of competition there, and many of those players, particularly in the accessible luxury space, which is, I think, what they're talking about here, are struggling. Now, some of that has to do more with some presumably more short-term kind of macroeconomic headwinds, but it's definitely a crowded area. And it's not clear specifically what they're going to do to really make a big play there. But I think directionally, it's a better move than staying stuck in the unremarkable middle.
Well, let's talk about the business that's given these department store characters some trouble, which is TJX. They reported solid results.
Well, it's pretty easy to draw a direct correlation, not just recently, but over many, many years, to the troubles in the department store and the growth of off-price retailers. They're really the people that have offered this strong value equation relative to moderate department stores, and they've packaged it in a more convenient location because of their real estate strategy and just the sheer number of locations. So this has really been a 10, 15, 20-year phenomenon that maybe is exacerbated by some of the economic pressures. But yeah, TJX reported net sales up 13%, so that includes a bunch of new store openings, but comparable sales growth of 5%. So broadly speaking, we're seeing department stores down 5, 6, 7%, off-price guys up 4, 5, 6%. And TJX at this point is a much bigger brand than Macy's is. So just really more of the same. The only other kind of interesting thing that came out is they did guide that they expected their sales to decelerate the balance of the year. So whether they're just seeing kind of this overall pressure, the shift to services, inflation, whatever it might be, they weren't super optimistic about the future, though clearly they're going to outperform the department stores and a bunch of other players. So
let's talk about the electronics category. Best Buy, they put out some results that were not fantastic. And I was in a local Best Buy, and one of the things that strikes me about the category, and I've talked to leaders in the category, is there's just not a ton of innovation happening in the electronics category to make me put away the products that I bought in, during the pandemic. I bought a new computer. Well, the computer I'd buy today wouldn't be all that much different. So I think there's both the retailer and the vendors got to step up and start bringing some products that consumers want to buy.
Yeah, one of the things that's happened with Best Buy is that they were, I want to say, getting cut a little bit of slack, but they've kind of gotten caught up in this post-COVID, the buy forward thing that we've talked about a bunch of times. And we'll talk about Lowe's and Home Depot in a second as well, as where it's just like, well, the home market is sort of slow and big ticket's kind of slow because people bought so much stuff. And, as time has gone on, you haven't really seen the sales start to improve very much. So they were down about 5%. There's definitely margin pressure on the business, and they keep kind of promising that they're about to round the corner, but it doesn't seem to be happening. And I'm starting to see more people kind of like you say, well, is this really, how much of this is other things going on, like the lack of innovation, like competition from Amazon and others, just a lot of the business moving to be very price commodity sort of oriented. And I was in a Best Buy yesterday and hadn't been in one in a while. And I was just struck by the lack of traffic broadly on a Sunday, but also, here is this massive store and there's just a lot of stuff in it. And, there's a lot of things, which is, it's just very easy to buy a lot of different places. So while they have a compelling appliance assortment, and, we understand why that's a little bit soft given the dynamics of the home market, to your point on the electronics side, the computer side, it's like, wow, there's just a lot of stuff here. Yeah. And what's really new and exciting. So they definitely,
which is their strength, right?
Overspaced. Yeah, absolutely.
Their strength is, hey, something really new and exciting. I want to go experience it in person and talk to somebody who knows what they're talking about. And then otherwise, I can buy the latest computer online because it's really only a step different than the last one. So I don't really need an expert to explain it to me. So I think they're really suffering from that a little bit, I think.
Yeah, I think so. So we'll see. And then just kind of moving on, we saw Lowe's, the big home improvement player, had a really weak quarter, another weak quarter. They were able to increase their net income a little bit because they're taking some costs out, but their comp store sales were down 6%. Now, this compares to Home Depot, which was down about 3.5%. So Home Depot continues, I think, to outperform Lowe's, but the category is really struggling. So again, we're kind of still caught up in this narrative of all the buy forward and the home market's difficult. But, at some point you got to think this thing is going to start to move in the other direction, if only because they're comparing to such weak numbers. But so far it hasn't really manifested.
Yeah, I think they're being, you remember our interview with Ira was talking about the market's kind of frozen a little bit. I mean, they need people moving and renovating and, they need all that stuff to really spark sales in that category a little bit more. And right. I think Home Depot just does way better in the contractor space than Lowe's does. So let's talk about eyeglasses. So I actually had the opportunity. Have you ever heard of Specsavers starting us in the UK, Ireland, and spreading like wildfire?
Heard of them. Don't know too much about them.
It made me think of Warby Parker. Fourth quarter net revenue increased 10%. The eyeglass business in general seems to be growing, but there's lots of competitors.
Yeah, this. So we've obviously talked about the digitally native vertical brands quite a lot on the podcast. Warby Parker, I think, continues to distinguish themselves in opening quite a lot of stores. They opened 40 stores last year. They're planning to open 40 more this year. So that's pretty good growth. This was, to me, kind of a mixed report. Wall Street definitely didn't like this quarter. And I think it has to do with just the expectation of more growth from this company. So, on the one hand, compared to some of the companies we talked about, 10.5% sales increase sounds pretty good, right? But they opened a lot of stores, going from about, just under 200 to over 200. So that's a nice percentage increase. And as a newer brand, you would expect that they would be continuing to grow their e-commerce business. And as we've talked about, I think a few times, the last several quarters, they continue to seem to underdeliver a little bit on the sales side. So I think this is raising questions about how high is up. They've talked about 900 stores. Opening 40 a year doesn't really get you there for a long time. It doesn't seem like they're comping all that effectively for such a strong brand, but they do put up some pretty good customer metrics. And they are not yet profitable on a GAAP basis, but they did considerably improve their operating cash flow. They had $7.3 million of full year free cash flow on a business about $600 million. So that's not massive, but it is positive, which many of these companies still can't say. They're clearly getting more operating leverage. They're clearly getting more productivity, and they are moving closer and closer to profitability. So that's a positive story. But like I say, I think the question here really is how big can this business ultimately be? And that's making investors a little bit skittish at this point.
Well, last thing, speaking of investment bankers and IPOs, interesting news with Shein talking about moving their IPO from New York to London. A little too much scrutiny here in the U.S., Bloomberg reports. I mean, we've seen this before with other folks moving to Europe to do their IPO. What do you make of this? Do you think it threatens their model here in the U.S., or what do you make of this? Is it just financial shenanigans kind of stuff?
This Shein IPO will be one of the more exciting IPOs of any kind, I think. There's a tremendous amount of interest as this business model is growing like crazy, is rumored to be profitable. But there's a lot of, whether it's mostly politically motivated or whatnot. There's a lot of scrutiny. Senator Marco Rubio here is kind of leading the charge, suggesting that Shein, aside from some of the questions about its ethical sourcing and all these kinds of things, is also basically a sham organization backed by China. Shein, of course, is pushing back that they're actually a Singaporean company and a bunch of other things. So the political heat appears to be quite high in the U.S., and so Shein is looking to have an alternative route to market. So going to London is certainly a strategy worth considering. I would imagine they would still prefer to go public in the U.S., given the New York Stock Exchange and being kind of the big kahuna. But this is just a brand that, on the one hand, is growing like wildfire, but just has a lot of questions that are being raised about how they operate. So I wouldn't be surprised if they actually just pursue this path in London as a way to get the company public later this year.
All right. Well, we'll keep an eye on that, and let's wrap the news there. And before we get to our fantastic interview with Andrea from Adidas, let's have a few words from our presenting sponsor, Celonis. Want to ramp up speed and productivity for your entire retail operation? In the Celonis Process Mining for Dummies Handbook, we show you how Celonis process mining technology, enhanced with process intelligent AI, can help you streamline performance across your entire retail business so you can drive lasting value from end to end. That means purchasing, supply chain, omni-channel execution, merchandising, and customer service processes, all managed and optimized through one powerful software solution. To get your free copy of Process Mining for Dummies and see how it's generated millions in value for brands around the world like Aldi, Globus, and Edeka, head to celonis.com/remarkable retail. Andrea, welcome to the Remarkable Retail Podcast. How are you doing this afternoon?
Thanks for having me. I'm doing great, thank you.
Fantastic. Where we are, it is still in the morning. Where do we find you today?
I'm in Germany, actually, in the lovely, quaint little town of Herzogenaurach, which is near Nuremberg in southern Germany, and it's the headquarters of Adidas, or Adidas, as you guys say.
That's the main thing we have to sort out is the correct way to say the brand.
Yeah.
Fantastic. Well, it's such a great brand, and we're so happy you were able to join us. And let's jump right in. We like to start a little bit by understanding and having our listeners understand the people that they're listening to. So tell us a little bit about your personal journey from law enforcement to McKinsey to leading a global retailer. Tell us a little bit about yourself.
I'm a small town boy from northern Italy. I grew up in a little village, and I was always curious about the world, and I wanted to see the world around us. So, best thing to do, I got myself, thanks to my parents, a good degree in a good university, and started a career that at every possible turn of the road would take me to explore and visit new parts of the world. I started off with a fairly technical line of work. I was a statistician in the beginning, predictive modeling, some seriously geeky stuff. Then I realized that would not get me to travel the world. So I got into brand management. I had a long stint with a global group called EssilorLuxottica, which is the global leader in the
glassware, right?
Yes,
eyeglasses. Yeah,
exactly. So spent a lot of time with them, and that is actually what got me to move to London first, and then to move to New York at some point. I was in New York for maybe 13 years. And beside EssilorLuxottica, I've spent time in the sports business with Oakley at the time. I ran a fashion retailer, Brooks Brothers. I worked for a private equity company and as a CEO of a portfolio company in a completely different space, kitchen and bath and luxury renovations. That was interesting. And then I spent 5 years in beauty with the Estée Lauder companies in New York, traveling the world still. Moved back to Europe as we were from here, so we wanted to at some point get back with our family to Europe, and had a great chat with some folks from Adidas who said, "Hey, how about you join us?" So I had to say goodbye to my friends at Lauder, and I joined. I was really attracted by the sports sector, the dynamic of the sports sector. Adidas is an amazing brand in so many ways, and I think their retail could do with some help. So here I am.
Well, you're right. It's a global powerhouse. I'm curious, and I think our listeners are really curious how, if I could describe it as an arc of your career. I mean, you've really gone from luxury to a big focus on retail. What have you brought along with you to the role at Adidas? You've got international experience. When you say Adidas maybe needs some bit of help in terms of the retail presentation, how do you ladder up all your experiences and bundle them together and become that leader at Adidas?
I guess we're all a product of our own circumstances. I always say, whatever we get to, 51% is what we don't control, whether it's luck or lack of that. But I think, as I told you earlier, I always loved traveling the world, seeing the world. I've always been a bit of a globalist as a mindset. But I think the more I evolved in my career, particularly having the opportunity to lead global organizations and to lead global teams, I have become really more of a localist. So I think if you combine the two, that there was this fad at some point of the global, local. It was global and local combined.
Yeah.
So I think I am a bit of a glocalist. I think, particularly in retail, I think business happens in localities. Business happens in stores. It's where a customer meets our products in an environment with some people that help them choose and find what they're looking for, and that is the core of what retail is. Everything else is built on that, but I'm of the firm belief that the person in the front line knows the best. So what I carried through my experience is always a belief that the people that are in the front line, the people that are exposed to the final customer, are the people that deserve the most respect, and that we should all be working to empower to do their jobs.
It's so interesting. Well, first of all, could you give our audience a sense of the scale and scope of your global retail network? Because I believe it's over 2,000 owned and operated stores. Do I have that number right?
Yeah, absolutely.
Which is quite vast. So, but yeah, maybe just give us a sense of what that's like, and what are some of the strategies you use to deliver that retail excellence, and how you apply some of the learning you've gotten over the years.
Yeah, well, thank you, Steve. You're right. It's about 2,000 owned and operated stores around the world. Is a sizable chunk of our business annually. Direct to consumer, or DTC, is about just shy of, actually probably in 23 was around 40%. And more than half of that comes from our stores. So it's an important part of our overall business. But being vertically integrated, I think that's the way we used to say once upon a time. So being the face of retail within a brand is not just being a pure retailer. It's applying the discipline of retail to a retail fleet, an organization that is there to do a couple of different things, to retail products, but also to represent a brand. So you're always having like you have this kind of two goals in mind at any point in time, and so one of the issues that, in my experience, I have seen with global brands that at some point get into their own stores and retail is that there's always a struggle in balancing these two sometimes conflicting objectives. One of represent the brands, enhance the brand equity, be accretive to the brand equity through experiences, through things that maybe are less efficient from economically, but are important to build a brand. So serve as almost like a marketing channel. And the other one, of course, of run efficient, operationally excellent stores, apply the disciplines of retail. So these two, combining these two, making them work synergistically as opposed to one against the other, these two objectives, is the big challenge for companies like Adidas. And so, yeah, in a nutshell, that is really what my job entails. How to bring the discipline of retail to an organization that is there to do more than just that. And so it gets measured in many ways on its ability to create great brand experiences. But at the end of the day, there's a P&L and there's a bottom line, and it's a public company where analysts are looking at every single penny that is spent or earned. And so I think that's what I do.
Sure. It's, it's funny, earlier on you mentioned about being a vertically integrated brand. And I think Michael and I have talked about this on the podcast many times, where in this era of the digitally native vertical brands, it almost seems sometimes like the people that focus or I guess hype those brands don't realize that vertically integrated retail has been around for quite a long time. But it's certainly evolved. And I guess my question is, as you think about this kind of ongoing discussion about the role of wholesale versus DTC, and then, the own store part of DTC versus the e-commerce part of DTC, can you give us any insight, I guess, as to maybe how that's evolved, or whether you and Adidas overall have had to think about it differently in the last few years, or is it really more just an extension of what's been part of good retail for a long time?
Well, it's funny you ask. There's been a huge debate over the last few years, particularly in this sector, because both Adidas and its largest competitor have made a lot of noise about swinging wholesale to DTC, back to wholesale, and in my opinion, personally, I believe it's a bit of it's almost like the wrong conversation to be had. For a brand of our size and for a brand of our size to thrive and be successful, you really have to think in terms of customer reach. At the end of the day, you have a trademark and a brand, and you create some amazing products. You want to reach some final consumers or final customers. And in between, there's the distribution. How do you distribute your products? And I think there's no single answer to the question: is it better to be serving wholesale partners? Is it better to open your own stores? Is it better to go full on digital? Every market commands a different answer. And we ourselves are doing a lot of soul searching around this, in the sense that my first question is, does this market need monobrand Adidas stores? Yes, no. Sometimes the distribution is so well developed that our job becomes to supply existing distribution that's excellent at doing what they're doing. And the market share gain is also in the shelf space that you gain through at your partners, at your wholesale partners. Other markets actually ask for monobrand experiences, for monobrand stores, because that's the way luxury fashion and luxury retail has gone over the last few years. And therefore, it makes sense to have our own stores. And, it needs to be always synergistic with the rest of the distribution. So there's no single answer, I think, and I think, honestly, and then, of course, you have e-com, which is in many ways also a necessity, but needs not be overemphasized. It's one of the ways in which customers get to know and to buy our brand. No hard and fast rule. And honestly, to be successful at our size, you need to be a great partner to your wholesale customers. You need to be a great retailer in your stores, and you also need to be excellent at doing e-com. There's no one that is more important than the others.
Yeah, no, I think that's a very good perspective. I am curious, given your global reach, whether you see important differences by geography? Because we do have a global audience, and even though most of our audience is in North America, I know there's obviously lots of different markets out there with different characteristics. Have you seen anything really profoundly different across the different markets you serve?
I think so. First of all, yes, there are major differences. In the last few weeks, I was in the U.S. For some time, and then the last 2 weeks I was in Asia, and I think to some extent there are some of the differences that have always been there. Some regions, some markets are more advanced in their adoption of transactional technologies. Others remain a little more hinged around service and high touch kind of service. I think, for instance, the difference between North and South America. In Latin America, a lot of retail runs on people and runs primarily on people. In North America, a lot of retail has been running on transactional technologies that allow people to look after themselves. And if you look at the differences between, I think Europe is a fast follower to the North America trend, and Asia is on different different stages of this, depending whether you are in Korea, Japan, or whether you're in China, or whether in Southeast Asia. So there are differences, but I think respectfully, and this is my own opinion, I do think that there are the commonalities in the retail process and experience are bigger today than maybe the local differences.
We're on the pod today thanks to the folks at the World Retail Congress. You're going to be giving a keynote address next month entitled Retailing in a Time of Mass Distraction. Could you give us and the listeners a sneak peek into the core message that you're going to be talking about, and what's that all about?
Yeah, so it's something I've become quite passionate about, and actually ties into what we just discussed on one big factor which we witness as common across markets and regions, and which is a certain type of call it evolution of the customer that walks into the stores today. The advent of the omnipresent digital tool we carry, the smartphone. If you think about it, it's 14, 15 years old, maybe just longer than that. But, since in the last 10 years, it really has started to be omnipresent in our pockets, in our lives, and with an increasing share of our attention being captured by these tools. And of course, it would be foolish to assume that doesn't have an impact on the way we shop, because it does, of course. And I think what we're seeing across the globe, in any market, maybe slightly different stages of development, but we see it everywhere, is that people are more distracted than they've ever been. There is this precious thing called attention, is a limited resource. All of us only have so much of it, and quite frankly, the demands on our attention from the digital tools we carry with us are quite taxing. And therefore, whilst years ago you had customers, I like to call them customers more than consumers, that used to walk the stores, being certainly more present, more patient, having more time to perform their tasks, being more tolerant of inefficiencies, tolerant of small disservices here and there. Now you tend to have a customer which is short on time and attention, expects a lot, is trained particularly by some of the digital services like the Amazons of this world to a flawless, super efficient service, constant availability, what they're looking for. But the attention component makes them really short on something that's quite precious, which is the time and the patience to go through a store, to discover the product, find what they're like. A group of us started noticing this thing as a global trend. And it's nothing new. It's something that we all observe in day-to-day life. But what we started doing is more connecting the dots between what we're observing happening in the stores time and time again, and what needs to happen in order for this customer to be happy and satisfied at the end of their shopping mission. Connecting these two things made us realize that our stores are not designed in a way that is conducive to a good experience for this evolved type of customer. And from this reflection started some of the work that we'll be sharing at the Congress.
It's super interesting because Steve has done a lot of work, and we've been talking about it on the podcast about these two type of buying behavior, the buying and the shopping. You know, I'm going to get something done. I want it done efficiently versus those who are kind of exploring. I might not know what the best shoe I want. I want to see what's new. And so I guess the challenge for you, and I'm sure the folks will love hearing about it on stage, is how you have both customers in the same store and how you figure that out in a retail perspective. Yeah.
Yeah. And, you know, a lot of the shopping nowadays is done, I guess you define shopping as the browsing element, right? Mm-hmm, Actually, funnily enough, once upon a time, people used to browse through a store. We used to say that. Now, if you say browse, people will assume that you're doing it digitally. A lot of the shopping, the unfocused looking for products that then become a more precise search and a deeper dive into the characteristics of what you're looking for happens through these devices. These devices never leave you. Just think about this for a second. You know, the customer in the store most of the times knows more about the product than the people that work in the store because they have been singling on certain things, looking, browsing, looking through all possible sites, comparison sites, brand sites. They have all the information they need, and they want that particular thing. At the same time, you cannot create a boring store like, a warehouse almost, where people come in and find exactly what they're looking for and walk out as fast as possible. So you're right. The challenge is, how do you create an environment where the customer that wants something finds it, right? Finds it quickly. Yep. And then once happy about that, can actually continue the exploration. And at the same time, the customer that walks in to just have a good time and look around. That is a serious challenge. And I think we achieve a lot of that through store design, through merchandising techniques, through communication, through the pathways that we design in such a way that, what we expect to be the products that the customer wants most, easy to find, and they're in a context where other elements attract them to other things once they have satisfied their primary need. We see a lot of that, particularly in the sector I'm in right now, which is a little more functionally driven at times, and where the trends are pretty clear, right? If you walk into one of our stores or one of our competitors, the trends are pretty clear, and you gotta lean in on those trends and make sure that you're catering for that before distracting people further and bringing them on a journey to see if there's something else they like in the store.
The art and science of upselling and cross-selling is not dead.
It is not. Quite the opposite, actually.
Well, Andrea, maybe before we let you go, we could just shift gears a tiny bit just to see if you have any leadership advice. You've been described as a passionate people leader. How do you create the culture of success, or maybe just any tips from your career in terms of how some of our audience might think about taking their career forward?
Yeah, thank you, Steve. It's a beautiful question, actually, that will probably deserve, I'm sure there's plenty of podcasts about exactly this thing, So I'm going to try and boil it down in a minute. I think something that I said earlier is very true to me. The workforce has been, all our teams are made of people that workers, and this group of people, of which I'm part, of course, has changed a lot in the last few years, and in ways, in my opinion, that defy a little bit the characterization that was given, well, the millennials are entitled and lazy. Well, the generation after that, they have different. We tend to pigeonhole people in these boxes for simplification. The idea is that there's more and more, I believe, that good leaders have a clear, solid, and sound understanding of what happens in their front lines. However you want to define the front line. If you're a manufacturer, it's your factory. If you're in logistics, it's the people in your distribution centers. If you're retailers, are the people in the stores that are helping your customers. And I think it's so important nowadays to understand how these people feel about what's happening. They know the truth. If something doesn't work, they know. If something is selling well, they know before any of your softwares will tell you. If something is not really resonating with the final customer, they know immediately. There's such a power in that. And I think leaders, particularly in my line of work, right, in retail today, that can tap into the richness of this are the ones that succeed. And of course, you got to marry that with an overall vision. You got to provide a context. You got to provide a framework. Otherwise, things don't make sense. But I think the first thing is respect the he or she who is in front of the customer. They know best. Mm-hmm. And great ideas, when you think of innovation, come to paying respect and letting these people speak, because they know what needs to change oftentimes. They'll know what doesn't work in a store. They'll know very well, and so being able to give them a voice and let them tell you what needs to change. I have amazing examples of great innovation that has come through this process. And so for me today, this is one of the things that leaders in this day and age need to do. Because let me say one last thing. We talk about the customer being empowered or powerful, having a lot of feeling that they control the game. Well, let me tell you, so does your employees. So your employee. So do your teams. They're more empowered than ever. They're smart. They're bright, and they know best in many situations.
Well, that is an excellent place, I think, to wrap up our conversation. Very inspiring. Andrea, thanks so much for joining us. I'm looking forward to hearing your presentation and hopefully saying hi in real life, as the kids say, in Paris. But thanks so much for joining us on the Remarkable Retail Podcast.
Thank you, Steve. Thank you, Michael. Thank you to both of you. It was a great conversation.
Well, that was a great interview with someone who has been in the retail business. I was just tracking his career, and he brings such a depth of retail experience, and it shows in the conversation that we had to his work at Adidas. And there's no shortage of opportunity, no shortage of competitors in that category. That's what struck me as I listened to him. Is he's the right person at the right time, but it's crowded. Yeah.
No, I love the diversity of experience. I love the global perspective. We sometimes spend a little bit too much time in North America, so it's great to get the more international perspective. I always think it's interesting just to particularly when you think about direct to consumer and just all the attention it's getting, not only from the disruptor brands but a lot of established brands like Adidas and Nike, et cetera, of how do you strike that balance between building the brand, having that direct relationship with the end consumer, but at the same time, driving store performance, driving brand performance. I thought that was a really interesting discussion. I'm really fascinated, though, to hear his presentation at the World Retail Congress, because this whole idea, I talk about this in Remarkable Retail, like we're in this. All retailers are really in this epic battle for attention, and consumers are just weapons of mass distraction, right? So in this world that is so noisy and so crowded, how do you become the signal amid all the noise to not only get their attention, but really engage with them and get them to fall in love with your brand? And so I'm curious to hear his take on that, and I'm curious to see or learn a little bit more about some of their specific strategies. So get on over to Paris to hear that. But I'm sure we'll end up talking about it post event as well.
All right, let's leave it there. Thanks for tuning in. New episodes of Season 8 presented by Celonis will show up every Tuesday, so be sure to tell your friends and colleagues in the retail industry all about us.
I'm Steve Dennis, author of the best-selling book Remarkable Retail and my new forthcoming book, Leaders Leap, Transforming Your Company at the Speed of Disruption, which will be published in April and is available for pre-order at booksellers everywhere. You can learn more about me, my consulting, and keynote speaking at stephenpdennis.com.
I'm Michael LeBlanc, consumer retail growth consultant, keynote speaker, producer, and host of a series of retail trade podcasts, including this one. You can learn more about me on LinkedIn. Safe travels, everyone.